consolidated financial statements that comply with IFRS. So that means this parent also has a further parent, and as long as that parent prepares consolidated financial statements in terms of IFRS, then this parent at the bottom does not have to prepare consolidated financial statements. All right, so that was just a quick recap of what is already in IAS 27. If we move on to slide number 29, the consolidation procedures. The basic consolidation procedures are explained in a few paragraphs in IAS 27 and in IFRS 10. They're basically saying things like they should be added together, eliminate common items, eliminate unrealized intra-group transactions, etc., etc. But we all know that consolidations are not that simple, and this results in 2 textbooks that have to be studied just relating to group statements. Now, your prescribed textbook is the group statements textbook published by LexisNexis. Many students ask us whether we're going to do detailed lectures on consolidation. Ladies and gentlemen, the best way to do a consolidation question is to work through the textbook. They've got hundreds of examples there, very good self-assessment questions at the end of every chapter. So that's the only way of doing group statements, testing it, going through it, seeing if you can do it, and if you get stuck somewhere, then you email us at CA Academy and then we can help you further. But to lecture this on video is very difficult, and by the way, the textbook group statements is also copyright protected. So we can't be putting that on video and just go and put that on YouTube or on our website and publicly display that. That is in breach of the copyright agreement. So that's why we do not do detailed lectures on group statements. That's by the textbook. That's where you've got to use your group statement textbook. All right, so that book is good, that book is detailed. Make sure that you understand the principles from there, and what you don't understand, email us about that and we'll help you further. The second point, the same reporting dates are required. We cannot prepare financial statements at different reporting dates, so we have to make sure that all of the reporting dates in the group are the same. Now, if this is not practicable, all right, so what does that mean? If after every reasonable effort to do so, it still cannot be done. Doesn't mean that you don't have to because you don't want to. If after every reasonable effort it is not able to be done, then we can accept the different year ends for the various sets of financial statements for the parent and the subsidiaries, but then we use the most recent financial statements of the subsidiary and we adjust them for significant events or transactions that have taken place up to the year end of the parent. And by the way, the new term for year end is now reporting date. So we talk about the reporting date of the parent. The differences between the subsidiary's reporting date and the parent's reporting date, if they are significant, those differences in the financial statements of the subsidiary will have to be included then in the group financial statements. All right. And then the difference between the subsidiary's financial statements and the date of the consolidated financial statements may be no more than 3 months. All right, so that's a rule. So even the one that says, if not practicable, you can just make adjustments for the subsidiary's significant transactions, even that cannot extend the difference between the subsidiary's financial statements and the consolidated financial statements to be more than 3 months. So what does that mean? If the most recent set of financial statements of the subsidiary is 6 months before the consolidation date, the subsidiary is going to have to be forced to prepare a new set of financial statements within 3 months before the consolidation date. Let's move on to slide number 30. Remember the principles relating to non-controlling interest. We don't talk about minority interest anymore. We now call it non-controlling interest in the statement of financial position. It remains part of equity, but we separate it from the equity attributable to the owners of the parent. Why is it equity and not a liability? Because it only turns into a liability once a dividend is declared, because then the group picks up a present obligation to pay out that equity to the NCI, and then that turns into a shareholders for dividend liability. So up to that point, there's no present obligation on the group to pay out that equity because no dividend has been declared. Therefore, it's part of equity. So remember our approach, even from the statement, the conceptual framework. How do we prove equity? By disproving a liability. All right, so remember how strong the definitions of assets and liabilities really are. and that we actually use them indirectly to prove things like expenses, prove things like liabilities, and if not a liability, then equity. So there's that indirect approach that is very valuable, because I know that you guys all know the definitions of assets and liabilities very well, so use them to your advantage. Profit or loss and items of OCI are attributed to the owners of the parent and the NCI based on the present ownership interests. Total comprehensive income is to be attributed to the owners of the parent and the NCI, even if the NCI is resulting then in a debit balance or a negative balance. So this whole concept of the minorities can only lose what they've invested, that doesn't exist anymore. That's old school. Forget that. If you account for the NCI and they go overall into a debit balance, then that is a debit balance in equity. Then their investment has gone negative and they owe money to this particular company. All right, so we don't place a limit on the debit balance of NCI. If they go into debit, that's fine. We put it as a debit on the face of the statement of financial position. And then lastly, the measurement of NCI at fair value or at their proportionate share of the net identifiable assets at acquisition date at fair values. It's very important that distinction is not affected by IFRS 10. That is brought about by IFRS 3. So it's very important that you consider following or continue following that particular classification, either at fair value or at NAV in terms of the NCI. That is not a measurement issue that is affected by IFRS 10. If we move on to slide number 31, the changes in ownership interest, ladies and gentlemen, this is what we spoke about earlier. If these changes do not result in a loss of control over the subsidiary by the parent, we recognize the resulting gain or loss on disposal in equity directly. Goodwill is not adjusted downward proportionately because we are not losing control. There's no significant event. All right, so we've discussed this in the lecture of IAS 27, so please look either on our website or in your DVD set for further explanation of this. All that I'm trying to point out here is that that concept was retained from IAS 27 into the new IFRS 10. Where control is lost by the parent de-recognizes assets and liabilities from the statement of financial position. That's logical. Do you agree? Because we don't control those assets and liabilities anymore, so they need to be de-recognized. That's step one. The parent then recognizes the investment retained in the former subsidiary, if any. Now listen carefully. We might be going from an 80% investment to a 40% investment. Do you agree? That is the retained investment. Now that 40% investment will be an associate in its simplest form. Let's assume that the power is determined by voting rights. 1 vote per share, you have 40% of the voting rights. You can only significantly influence the relevant activities. You cannot direct them. Do you agree? So you're dealing with an associate then. Then the first step would be to equity account that associate, because that is what happens at the date of loss of control. And then that equity accounted carrying amount of the associate on the date that you lost the control and you went from 80 to 40. The difference between that equity accounted carrying amount and the fair value of that 40%, if you look at market price, that is to be recognized as a gain or loss in profit and loss. And that basically goes together with the gain or loss on disposal of the 40% interest. So what must you remember? This paragraph 34 basically brings about that concept that the gain or loss on disposal, that means when you lose control and you have that line item that says gain or loss on disposal of controlling interest, okay? That consists of 2 elements. Firstly, at group level, the profit or loss on disposal, okay? So that means the selling price less the profit that was made in the separate books of the parent. But then we've also got to take into account the reserves that we've disposed of at group level. So that's normally going to reduce the group's profit on disposal. Do you agree? That's part A. And then the second part of your gain on disposal will of course be the remeasurement of the retained investment from equity value to fair value. And those two together form the gain or loss on disposal of this investment. Now, this is my interpretation. The standard isn't clear on whether these two should be presented separately, whether they should be presented together as one item. What I prefer to do is I calculate the two components, add them together, and put in the note disclosure that they consist of the group's gain on disposal or loss on disposal, and secondly, the remeasurement gain or loss on the retained interest in the former subsidiary. So that's my interpretation, and that's also an acceptable way of doing it. That's not the only way of doing it. All right, so those are the two paragraphs that I would like to emphasize again in terms of IAS 27. And then if we move on to the last slide for this lecture, the disclosure, what's important, IFRS 10 does not bring about any disclosure. This disclosure is brought about by IFRS 12, disclosure of interest in other entities. And you will see that IFRS 10 and IFRS 11, dealing with joint arrangements, they do not have their own disclosure. Because whenever you have an investment in a subsidiary, an associate, a joint venture, or an unconsolidated structured entity, you will have to comply with the disclosure requirements of IFRS 12, and that we'll deal with in a separate lecture. All right, the effective date of IFRS 10, 1 January 2013, that's technically irrelevant to you because in your exams, QE, as well as your CTA exams, you always use the latest examinable pronouncements, and IFRS 10 is one of them. I hope you've enjoyed this lecture. I'll see you in the next lecture.